Hello everyone, welcome to the Potion community call. We are about to get started, but as you can see there's a quick disclaimer on screen, and just to let you all know that the call is being recorded. So I'm going to hand over now to Alpha Block.
Thank you so much, Snoo. Can you confirm that everything is coming through okay?
Yeah, we can hear you, Alpha Block.
Perfect. Awesome. So thank you so much, Snoo, and welcome everyone to another community call. Today, it's all about Potion analytics. We've been working on this for a lot of months, and we're really excited to finally be able to share it with all of you. And we have a lot in store on this call, so we're going to go straight into it. This is how we're going to organize the call. We're going to start with a pretty deep introduction into Potion analytics. I want to explain where the Potion analytics fits within the rest of the stack that we developed. We want to talk about this concept of sustainable alpha that we think is super important. And then we also want to talk about programmable alpha, which I believe is one of the key value propositions behind Potion. And then a couple of people that you haven't heard of from the team are going to be doing the next couple of sections. The first one is going to be about a quick benchmark comparison between Black-Scholes and the Kelly Criterion, which is also available in Potion Analytics. And then finally, Mike is going to be talking about fat tails, why they matter, why they're so important, and how they are fully supported out of the box in Potion Analytics. So that's the agenda for the day. Let's get into the intro piece. It might make sense to start just looking at the highest level possible to understand how Potion Analytics fits into the overall picture. And you can think of it almost like as a laboratory. That's where you experiment, do back testing, play around with different curves, with different configurations of assets and durations. So you get a feel for what to expect if you are to underwrite, for example, Uniswap very much in the money versus something that's less risky, very much out of the money. So that's kind of the place where you actually write the recipe for Potion. Then we have the Web3 interface. That's what Aureliano shared with all of you a couple of weeks ago. That's the typical Web3 web page where you are actually able to take the recipe and start brewing it. You can think of it almost as the kitchen. And then finally, through the interface, you're able to write that recipe fully cooked into the blockchain. And at that point, it actually becomes consumable. So that's when the potion is fully cooked and it's ready to serve. And sometimes we joke about this idea that when you drink a potion, what you're getting is these superpowers. You know, you're getting the power of protecting yourself against black swans and other perils in DeFi. Going a little bit deeper into Potion analytics, just consider for a second the perspective of an LP. You can think about the Kelly machine, which is the smart contracts that we developed, as kind of a black box. And the idea is that on this black box, as an LP, you send liquidity, you write a price bonding curve. As you will remember, in Potion, every LP is able to commit their unique bonding curve. And then from then on, that liquidity is actually made available to the market. So people can go ahead and buy, for example, put options, call options, and other such risk instruments. And the whole idea behind this is that this LP expects that after some trading, his capital is actually going to start growing. And for the purposes of Potion analytics, we put a huge amount of effort in characterizing these returns in a way that is simple to digest for regular people. And we normally talk about two fundamental dimensions. One is growth, and the other one are drawdowns. And let me actually show a short demonstration for what we mean by alpha and what we mean by a drawdown. So here you have like an imaginary series for the capital of the LP. So you have to imagine that this is The LP, he placed some collateral into the Kelly machine, and then the Kelly machine started trading, and you can see that it goes up, it goes down, it kind of has all this shape. When we talk about growth and we talk about alpha, we're looking at this idea here. We're looking at what's the final capital after the simulation horizon relative to the original capital, without taking too much into consideration whether it went up or below this line. We're just interested in the kind of the carrier wave for this process. And then when we talk about maximum drawdown, this is the highest loss that the LP experienced over the course of this period. So we're not looking at what's the loss relative to the initial capital. We're looking at the maximum loss experienced at any point in time. And so with these two parameters, as an LP, I can get a good idea for whether this investment was good in terms of growth, and also whether this investment was super volatile, super risky. Potion Analytics is all about helping you find the pricing curve that produces the growth and drawdown that you're willing to accept. And we're going to spend a lot of time today showing you how this actually works. This is what we're going to get into in a moment. These are the series of utilities that we've developed to help LPs make those decisions. But I just wanted to start by saying that we have like 6 Streamlits. For those of you not familiar with Streamlit, this is one. So it's basically a Python script that has a lot of interactive components that allows you to basically in real time modify parameters. We also have Jupyter Notebook versions. For those of you who are into data science, you'll be familiar with those. We have a dedicated branch just for fat-tailed assets. They're that important to us that we had like an entire branch dedicated to that. And then we also have an Excel simulator. It's not as sophisticated and not as advanced, but it does include kind of the basic functionality. And for those of you who maybe are not super familiar with Python, this is hopefully going to be of use. And finally, I also want to make the point that you can think about this collection of utilities in 2 categories. Some of them are more educational in nature. They're more about communicating the basic principles behind the Kelly criterion and the Kelly machine and so on. And then there is another set that is more geared towards actual implementation of curves. So they actually help the LP come up with a curve recipe that can be later implemented on chain. So we're now going to switch in a second into the demo section. But before, I just want to try and summarize what we're going to be trying to show in the next few moments. The very first intuition that hopefully we can land is that utilization is a fundamental parameter when taking risk, especially when you're thinking about survival. The second big intuition is that when you are using Kelly optimal curves, you are trying to get this idea of sustainable alpha. And that basically means that as an LP, you are expecting not to go bankrupt. And then the final one is that you can actually go beyond Kelly optimal curves, customize them, and in doing so, end up with what we call programmable alpha. And when we show it, hopefully this will make a lot more sense. So let's get into it. I wanted to start with a really simple demonstration for this intuition about utilization as a key component of risk management. And what we have here is a really simple scenario. We have an LP that has $100, and this LP is not selling options. He's just entering into coin toss bets, okay? And here we have a particular series of results for the coin toss. So on the first trial, the coin is positive, you win, and then you lose, you win, and you win. And what we're going to be looking at is how would an LP fare in 3 different scenarios. A scenario where he has a betting strategy where continuously he's putting 10% of the available capital at risk. A strategy where he's continuously putting 50% of the available capital at risk. And then finally, somebody that is putting 100% of the risk. For clarity, let's go through one of the examples. So I start with 100 and I put 10% of that at risk and I win. So I'm at 110. Now I have 110. I put 10% of the 110. But because I lost, I go back to 99. And you get the idea. I lose 10%, I lose 10%, I gain 10%. And overall, this guy is 8% ahead. Contrast this with this strategy against exactly the same sequence. You know, it's exactly the same coin, exactly the same sequence. But because this guy had a different strategy, it went from 100 to 150, and then half of that. These two halvings really hurt the bankroll. And so it's really going to be very difficult from 38 to crawl back up. And you can see that in the end, he finishes at minus 16%. And then finally, consider this person who is actually putting 100% of capital at risk. With a single loss, they go bankrupt. So hopefully this helps you get this idea that when you're trying to price risk, one really important parameter is kind of what are the odds of the things that you're trying to underwrite the risk for. But another incredibly critical parameter is how much of your capital are you putting at risk. And now finally, we're going to switch over into Potion Analytics, which I'm incredibly excited to finally be sharing with you guys. And let me just introduce you briefly kind of the architecture and the layout. So these are the 5 utilities available in the Streamlit. We have this Kelly Academy, which is what you're seeing on screen, which is nothing about the Kelly machine. This is pure Kelly Criterion intuitions. And this is kind of illustrating the coin toss scenario. And then we have more advanced sections that we will be unveiling one by one over the course of the call. So let's now focus on this coin toss scenario. It's this same idea that I showed here. You're just flipping coins and trying to understand what's the optimal betting strategy that I should apply. You know, is there a betting strategy that is better than all? That's what the Kelly Criterion gives you. And what we have on screen right now is the parameters that you're able to play with, starting with what's the win rate of the coin toss. And you can go for a coin toss that's really biased against yourself. You can go for a coin toss that's very biased to yourself. You know, so when we say 83, what we're saying is that out of 100 flips, you would win 83 times. And here what you have is what's the sequence of bets that you want to analyze. And you can go from 10 all the way to like a full year of daily betting. But now let's for example, leave it at 30. And let's also go back to maybe a more reasonable coin toss. I like 60. And here we're seeing the very first result from Kelly. So back to this idea of I have some statistics from the asset that I want to secure. How can I find what's the optimal bet size strategy? This is exactly what the Kelly Criterion shows. So here on the x-axis, you see several possible bet size strategies. I hope it's making sense that when we say 10%, that's what we're referring to, this continually betting 10%. And the same thing for the rest of the axis. And you can clearly see that there is one particular bet strategy that delivers a higher expectation of growth than any other strategy. And you can also see that after a certain size, after a certain percentage of your bankroll, your expectation actually goes to 0. Like basically Kelly's telling you, you're going to go bankrupt. Let me actually show you what happens when I increase the number of bets. This is interesting that you see that this thing goes up because this is showing the expected terminal capital, but it's not moving. You know, the bet fraction remains the same. So it's not a function of how many times you bet. It's purely a function of what's the risk of the underlying, in this case, this coin toss. And what we have on the right-hand side is actually a Monte Carlo simulation. So let me briefly demonstrate how this works. So here I have the number of simulation paths. When I select 10, I just have 10 lines. So each of these lines represents a series of 46 bets. Remember, see on the x-axis, I have 40. I could go much longer. And this you can see that this is now a longer series. And each of these paths is simulating a random scenario of a coin toss, always complying with the odds here. So each of these paths assume the 60% odds. Obviously, the more paths that I have in the simulation, the more robust the statistical performance becomes. And on this final slider here, what you control is what's the simulated bet fraction that you want to apply. And let me just really quickly show, maybe with less bets, back to the 30 bets, the numbers don't go so crazy. I start with a low fraction, so 3%, and I see that the median result is 122. Let me increase this to 16. Now it's 202. And at 26, I can see that it already goes down, 161. I go to 40, 93, 62, 5. And you can almost see visually, just looking at the paths, that when I'm simulating this percentage, you can just visually see that the median result is a lot lower. In fact, at 74, the median is already 0%. Bear in mind that this is a log scale, so this is already a very small number. And definitely, if you go to 100%, look at the paths. So in some sense, what you're seeing here is what's being analytically predicted by Kelly, and then you can see like an empirical confirmation of some process that doesn't know anything about Kelly. It's just flipping coins and showing them on screen, and you can see how it kind of demonstrates that Kelly works. You know, that it is true that at around 20% is the strategy that leads the highest mean result. Let's now transition into still a coin toss, but a slightly more sophisticated coin toss. So we're now going to start assuming that this is a bet that is biased against me. So I only win 40 times every 100 trials. However, in this case, I'm actually going to be charging to enter into a bet. So I'm going to be taking clients, and clients can play against me. We can flip a coin, and then we'll split the results. But I'm actually going to charge a premium. It's almost like I'm going to charge a fee before I'm actually going to accept a bet. And take a look at this chart here. This chart is showing 20 potential premiums going from 0 to 40%. And what you can see is that the initial premiums, you know, the low ones, the 0, the 2%, the 4%, and so on, these guys, they kind of go down immediately. You know, there is no optimal utilization strategy. Just like if I put something below 50%, Kelly's telling me you should just not bet. Like, what's the optimal bet fraction? 0. Because if you were to bet anything else, then your capital is gonna decrease. So here we're actually putting 40, and what we're seeing is that these initial small premiums are just not enough to counter the negative odds. But we also see that there are actually some premiums that do have some expectation above 0, right? You can see these. Let me see if I get like a better thing. So this guy, the 40%, the 38%, the 36%, all of these premiums combined with this risk do lead to a positive expectation. So right there is an important intuition, which is that by charging a premium, I'm able to alter the expected outcome, and therefore I can kind of make things work for me as an LP. I can choose the premium that guarantees that on the long run, I'm going to make money. Just like a casino, you know, like a casino may lose temporarily, but over the long run, they have an edge. This is the same idea here. But beyond that, it's actually helping you detect which are the premiums that lead to a positive expectation and which are the premiums that lead to ruin. And not just that, but you notice that for each premium, the optimal strategy is different. This guy, the 40% premium, seems to have the maximum around 25%. The 38% premium has the maximum at around 23%. The 36% premium has the maximum at around 18%. So notice, like, if I could picture this maximum, it's kind of going to the left-hand side. So keep that picture in mind. And now consider this new chart, which is no longer thinking about coin tosses. This is now thinking about put options. In particular, this is looking at an AVE put option with 107% strike. So this is 7% in the money for 1 day duration. And this chart that you're seeing here is the same idea of this guy here. I'm just plotting different premiums, and I'm asking the Kelly criterion, what's my likely CAGR if I was to charge that premium? And just like we saw before, there are some premiums that are just not enough to lead the LP to have alpha, to have growth, right? They actually have this kind of monotonic decrease factor. Then you have these premiums that are almost like too expensive, you know, like who's going to buy from you? You're charging such a crazy premium. And then we have these premiums in color, which seem to be kind of in a happy medium in between the too low premiums and the too high premiums. It's exactly the same curve. All we're adding is the dots at the premium. And the big breakthrough that we had is that we thought, could we actually build a bonding curve that is emergent from these local maximas? Like if instead of this chart with 10 premiums, we had like 100 premiums or 1,000 premiums, I could have potentially infinite resolution for what is the optimal premium I should charge for any given utilization. And so this would be the idea. An order comes to me, and it's an order that makes me go to 60% utilization. So I could come onto this chart and I would say, well, what's the Kelly criterion optimal premium to charge? 26.24. If I get an incoming order that asks me to put 40% of my collateral at risk, I can come to this chart and say, what's the premium that happens to be Kelly optimal at 40%? It's 10.68, right? So hopefully this gives you like a simple intuition for how these bonding curves are built. There are some mathematics here that I'm going to skip for now, but fundamentally, you can find these points simply by setting the derivative equal to 0. This is what's being shown here. And from that, we can find these bonding curves. And what you're looking at here is a tailed version of Bitcoin for 120 days. But notice how I can design these for 70 days. I can design it for a year. I can design it for a week. You know, that there is no constraint to the instrument that I can insure. Also, I want you to notice that in here, we're actually showing two things. We're showing the raw premiums in green and the hyperbolic cosine premiums in red. And you may be saying, well, I actually don't see any green. That's because it's underneath. The fit is so strong, is so good, that they actually match kind of perfectly well. Let me actually see if I go for a shorter duration, I think you will see a little bit of the green. It's hard to see it because it's really a really close match. But that's what we were explaining in one of the earlier calls. We didn't know that this shape was going to be a hyperbolic cosine. We kind of figured out what was the optimal bonding curve, and then visually we just recognized that these just looked very similar to a hyperbolic cosine. And then when we actually fitted them, we noticed that they exactly match one another. By the way, I don't know if we explained this before, but this is the actual parametrization of these bonding curves. They have 4 parameters, A, B, C, and D, that are combined with the utilization of the curve to be able to define the full range of premiums that an LP should charge for any given utilization. And so hopefully by now, at least you're getting this intuition that if you're going to be taking continued bets, utilization is a fundamental thing that you should take into account, and that the Kelly criterion is the best tool that we have to figure out what's the best possible strategy that you should employ. Let's now switch gears and go into sustainable alpha. And for that, I'm going to go back into this Streamlit from Potion Analytics. And what we're going to do is we're going to backtest. So remember how we were backtesting the coin toss here very simply. By the way, I didn't mention this. If you see this mesh, that's because a coin toss is binary. I can either win or I can lose, you know, and so there are not that many possible paths. There is like a finite number of paths. Here, it's different, because with a put option, it's not binary. I can win 1%, I can win 5%, I can lose 20%, you know, so there are all possible combinations. And that's why the chart looks a little bit different. So what we're doing is, when we say that we're backtesting, what we're doing first is we're working out what's the optimal bonding curve for this instrument. In this case, this is AVE, put option, 9% in the money, 5-day duration. And definitely I could choose a different insurance level or a different duration. You can notice here the fact that this is stepped has to do with the duration. If I increase the duration, you will see that the steps are wider. And if I go to 1-day duration, you will not see any steps. Let me go back to, you see now it looks more like a stock chart. Let's go back to, maybe let's do a weekly. So we're now going to look at the back test for 1 week insurance, 9% in the money for AVE. The next decision that you have is, how long do you want the simulation to run? And in this case, we're looking at 170 days, but again, I could make this 17 days. So as an LP, maybe I'm just going to be around for a little while. Maybe my investment horizon, let's say it's 3 months. So I just want to have an idea for what happens when I'm LPing on this instrument for 3 months. Obviously, you can also make this as long as you want. The other parameter that you have is the number of paths. This is the same thing that we were looking at before. Here, there are 150 different lines. And there is a special line, which is the white line. And this white line is just like the dotted line here. It's the median bankroll out of all the simulations. And I want to show you something that we found to be incredibly exciting, which is this lever here, which is the premium offset. So this premium offset is what you can add or remove from the Kelly optimal curve. So if I add a 20% offset, what I'm doing is I'm multiplying every single premium along this curve times 1.2. So I'm just adding 20% across the curve. And obviously, if I decrease it, then I'm doing the opposite. I'm lowering the premiums. So let's see what happens when I increase the premiums, let's say 30%. Maybe I should look at this. You remember the white line that was kind of straight before? Now is stepping up. This makes sense. You know, if for the same environment, the same simulations, I'm charging more than I was charging before, then statistically, I should make more money than before. Notice now what happens when I reduce the premium by 30%. The white line is now tilting downwards. So this is saying, you know, if you're pricing this instrument with a curve, like an optimal curve reduced by 30%, then, you know, statistically, you're going to lose money. I could go to minus 10%, and it's still going to be ever so slightly negative. I hope you can kind of see that it slopes down a little bit. The big point that I'm trying to make is that organically, when I find an optimal bonding curve, what's happening is that I'm pricing assets such that I produce this type of response, a response with almost like a neutral growth rate. So that's why we speak about sustainable alpha for 2 reasons. One, you have some statistical guarantee that you're not going bankrupt. Kelly is making sure that you're pricing in such a way that you're going to compound over time. And secondly, it's sustainable in the sense that you're not overpricing massively. You know, it's not like you're taking advantage of the buying side. It's almost like a neutral middle ground between the sell side and the buy side. Let me actually also show you the CAGR paths. So the CAGR paths are basically for each of these bankrolls. This is actually the same information, just shown in 2 different ways. In here, I'm just showing the bankroll divided by the initial bankroll. So when I see 2, that's a 2x. When I see 0.5, that's I'm halving my bankroll. And 1, obviously, is I'm staying the same. Here, what we're looking is at every point in time for each of these lines, I'm calculating what's the current CAGR. What you can see is that there is some kind of reversion to the mean. So initially, the CAGRs are very volatile. That's because, like, if I win, like the early winners, if they win like a lot in a short space of time, then annualized, the CAGR becomes crazy. But then as I do more and more bets, you can see that the craziness kind of finishes, and I kind of revert back to the mean. Let me actually zoom in a little bit into this section. Notice how the median CAGR, which is this white line, quite rapidly seems to converge into some mean. This mean is actually what's being predicted by the Kelly criterion. So at 70%, if I'm expecting a CAGR of 40%, that's when I'm going to see the white line converge to the 40%. Let me also really quickly do again the premium offset. So notice how the CAGR is converging to about 28%. So I'm now going to increase the premium by 15%. So this is now going to recompute, and we should see that the median CAGR is now seems to be 132%. So you can almost, like, sometimes we think about this as, this is my dial, I have the Kelly criterion tunes my pricing to this neutral zone, and then I have a dial, and I can program my alpha. I can decide where do I want this white line to converge. Do I want it at the 28 that was before, or do I want it at the 132? So I mean, this is a very long script. I'm not going to have time to go through all of it in detail, but I just want to maybe just browse quickly through it. This picture shows you in this particular simulation that had 150 paths. In this visual, it's kind of not easy to see what's the median, because they're all overlapping each other. So it's hard to see where are they concentrating. And so the 150 paths are now shown as a dot. So every one of these dots is a single path. And for each of these dots, we measure 2 dimensions. The maximum drawdown, which, as we explained in the beginning, is the maximum loss incurred over the life of the path. So the path here goes up, goes down, and so on. So this is saying for each of these dots, what was the maximum loss that they experienced relative to the peak, and also the growth. And you can see the median for both the CAGR and the drawdown. And then we have a bunch of financial measures. You can see here kind of what's the distribution of the CAGR, what's the distribution of impermanent loss, what's the distribution of the Sharpe ratio, and as well as the distribution of drawdowns. Here, we actually really like this chart, but one of the tests that we wanted to make was, well, the Kelly criterion is kind of telling me that at this util, I should expect that CAGR. And so we actually back-tested across the entire utilization range, and we compared the back-tested median against the analytical result expected. And hopefully you can see that there is an incredibly clean match between what was simulated and what was predicted. And with this, we can also give an intuition to the LP as to how dispersed the results are, and kind of what's the worst case scenario, all the way from like the 0 percentile all the way to the 100th percentile. And we can do this for the growth rate and also for the drawdown. So we think that for an LP, both are important. It's not just will I grow, it's also, how is my life going to be as I'm growing, And so you can see that in here. And yeah, once again, I'd love to actually spend a lot of time on these ones. You can't imagine the effort it took us to get all of this together, but I just find this chart to be incredibly clean. What you're looking at is Monte Carlo simulations for different amounts of strike. So this is 20% out of the money. This is 50% in the money. Look at this incredibly clean result. So I know that if I'm underwriting like very deep in the money options, my variance, my CAGR variance is going to be higher than when I'm underwriting 20% out of the money. So as an LP, this gives me an idea for, should I be underwriting this type of instrument or should I be underwriting that type of instrument? But notice that regardless of the strike, the Kelly criterion just finds that horizontal white line that I was talking about. It just finds this neutral scenario that almost like leads to zero CAGR expectation for the LP. And we can also look at the same thing for drawdowns. I'm interested in like what's my drawdown experience when I'm out of the money versus when I'm in the money. And here we had like an interesting result, which is that at the money seems to be kind of the riskiest trade you can make, at least from the perspective of max drawdowns. The same thing for duration. So here we're looking at 1-day duration versus 30-day duration. And once again, we're looking at CAGRs and drawdowns. And hopefully you're getting kind of the picture. This is to help the LP make decisions. Should I be writing options that are short duration? Should I be writing options that are long duration? Well, I can come to Potion Analytics, I can do my back tests, and I can get an intuition for what to choose, what kind of works best for me. And while we're at it, notice how the long durations seem to be less risky than the short durations, and more stuff, guys. I think I'm already overrunning a little bit of time, so I'm going to skip some of that. Maybe just to mention that we have 2 sections here that deal with what happens when you have an error in your estimation. And we also have a section that deals with what happens when I don't have constant util, but rather I have util that is more random, that in this case oscillates around a fixed util with some standard deviation. And what happens when I have fully random utilization. But kind of the bottom line is that regardless of whether you backtest this with fixed util or random util, you always get this idea of sustainable alpha. Okay, guys, I think I'm going incredibly slow, so I need to speed up a little bit. Hopefully you, from this last section, you got this intuition that when I'm using Kelly optimal curves, automatically I'm tuning my pricing to deliver sustainable alpha. And now let's go into programmable alpha. I'll try to do this as fast as I can. Now we're switching into this world of we're no longer doing kind of academics. Now we want to actually build a curve that we can implement on chain. And the example that we're going to use is Ethereum. But notice that I could choose Aave, Brent oil. We have the euro dollar, Dogecoin, gold, Microsoft, Tesla, Nikkei, the S&P 500. Like there is no limitation to what you can price like this. But in this case, we're choosing Ethereum. And you will notice that we have in yellow the full history, and then we have in red a really bearish segment, and in green a really bullish segment. You will see why we're doing this in a moment. When you are training your bonding curve, one fundamental piece of info that you feed into the system is the distribution of returns of the asset that you're trying to underwrite. And so here we're calculating 3 histograms, or 3 PDFs, or 3 returns distributions. In yellow, it's the full historical data. In red is the bear segment, and in green is the bull segment. Notice how the PDF for the bear segment is kind of shifted to the left. That kind of makes sense. In a bear market, I have a lot of kind of negative results. That's why I see a higher frequency on the negative results. And the opposite with the green line. When we're selecting a bull segment, I'm shifting the histogram to the right. And what we're going to do is we're actually going to create 3 bonding curves, 1 bonding curve for each of these scenarios. So in red, I have a bonding curve that is optimal for the bear market. In yellow, I have a bonding curve that is optimal for a full market. And then in green, I have a bonding curve that is optimal for a bull market. Notice how Kelly is able to detect that in the scenario where you're in a bear market, the odds are kind of against you. And so to offset those negative odds, you need to compensate with a higher premium. And how contrarily, when you're in the scenario where kind of the market is going in your direction, you need much lower premiums because kind of the market is doing the job for you. So now let's back test this. But here I want to introduce you to this idea that I can back test it against different markets. So here we're going to assume that I have a Kelly machine that I have programmed with the yellow curve. So I'm going to assume that I'm going to be facing kind of the statistical behavior of a full market. But I'm actually going to test it against 3 different market scenarios. I'm going to test it against a bull market, a full market, or a bear market. And obviously, if I'm pricing with the yellow curve and I'm actually in a bull market, my life is really good. I'm having a lot of fun, and I love it like this. I don't want anything to change. I'm getting a lot of money. If the market that unfolds is kind of like I expected, then I get the traditional Kelly criterion response that we saw a moment ago, with the median being positive, but with some possibility of losses. And look at the red one. The red one is quite painful. I'm not so happy with this one. If a bear market unfolds, there is a good chance that I'm going to lose money. So how do we get into this notion of programmable alpha? Well, what you can do is, because you don't know what market is going to unfold, you don't know if a bear is coming or a bull is coming or a full market is coming. What you can do is you can create a customized bonding curve that crosses the 3 markets. So let me build it really quickly. So I'm just going to experiment a little bit with the 3 parameters. I already got a curve that looks, maybe it's a little bit too high over here. Maybe I'll make it a little bit more eccentric like this. Maybe let me make it more like that, just for the sake of example. And now let's backtest this. Look at these guys. Do you remember how the red curve was before? It was kind of this really nasty thing that we were saying is really unpleasant. Look at what's happened. I don't know what is going to happen. I don't know which market is going to come, but I'm able to backtest it against all these different markets, including severe bear markets, and I'm able to get a representation for what's my expected CAGR, and not just the CAGR, but also the drawdown. And further to that, if I was just not happy with a 40% drawdown, if kind of my risk tolerance was lower than that, I can just come back here and I can simply just maybe make the curve a little bit higher. Now I think it's going to be quite a lot higher. But what you will see is that now I'm kind of affected by changing the curve. I'm completely altering the risk-reward performance. So that's kind of the cycle. You select the parameters of the contract, the duration, the strike, the asset. You select the market training data. You select the market testing data. You choose some utilization model. You put it through Potion Analytics, and then you get this idea of what's the statistical reward expected, what's the statistical risk expected across the testing data set. If I'm not happy, I customize the pricing bonding curve, I get a new result. If I'm not happy, I keep doing that. And then once I'm happy, I get the reward and risk that I'm happy with, I can go ahead and actually write it on chain. And this is what we saw. You saw these 3 curves and kind of the response that optimal bonding curves produce, and how when I actually go beyond Kelly optimal and I write my custom bonding curve, I'm able to massively affect the response. I'm able to avoid being highly utilized on a market that I wasn't trained for. I'm able to create this vertical wall against risk, and I'm also able to create a shelter against like really nasty drawdowns. So guys, I'm sorry that it took me a little bit longer than we were expecting, but hopefully these 3 big ideas kind of landed. The first one, utilization, is fundamental. We saw how the Kelly criterion helps you find the optimal one. We saw how when you build optimal bonding curves, you generate these horizontal white lines that are kind of market neutral. And we've also seen how by going beyond Kelly optimal curves, you can actually enter the domain of programmable alpha. And with that, I'm going to hand over to my friend and esteemed colleague, Igor, who's going to be talking to us about Potion Analytics in the context of benchmarking the Kelly criterion against Black-Scholes. Over to you, Igor.
Hello, everyone. It's a pleasure to meet you. I'm Igor, one of the data scientists from the Potion Labs team. Also, please let me know if you hear me well. It's important for us.
Perfect. All good.
Okay, good. So first of all, congratulations on making it to the part 2 of today's lecture. The amount of info you are getting over here is overwhelming, and your effort is appreciated. We need people who understand what we are doing over here. So by far, you probably already have some idea about Kelly criteria, and that we could price any risky asset with that. And now we are going to look at that from a bit different angle, which is comparison of Kelly Criterion versus Black-Scholes model. You probably already heard of Black-Scholes model. Nobel Prize was awarded for that. Black-Scholes is really cool. If you don't know much about it, I really encourage you to learn about it after the lecture, just because it's incredibly fun. But before jumping right to that, I need to introduce a couple of abstractions which we are going to use in the future. Those abstractions are return distribution and volatility. I'd like to think of returns distribution as of alternative way to look at the history of returns if we don't care about the order of returns. Let's look at the graph. Over here at y-axis we have the probability density. At x-axis we have annual returns. And returns distribution shows us the frequency of returns. So basically for the blue curve over here, returns of minus 0.2 is much less likely than returns somewhere near 0. And high volatility is high frequency of returns far from average return, and low volatility is the opposite. And I bet you clearly can see the difference over here. Volatility is basically just the variability of returns we are getting. So with that in mind, let's jump right into action. And let's try to compare Kelly versus Black-Scholes. And let's start with the inputs. And frankly, inputs are pretty much the same. Most of the fields over here are just definition of the option. It's duration, strike price, spot price. The key difference is volatility versus returns distribution. Black-Scholes does not take much information about the distribution. It's just one number which characterizes all the distribution. And in case of Kelly, we are getting full information. And it makes results of Kelly model much more sensitive to the returns distribution. And I promise to show you that live in a few minutes. Now let's jump to the assumptions. For the Kelly criterion, we have only one assumption, which is that returns distribution is staying the same, because we are basically learning our Kelly model with those distributions, so it perfectly fits to the returns distribution we feed into it. And for the Black-Scholes, we have lots of assumptions, and for both of the models, especially in the real world, none of those assumptions are true. And actually, no one cares about that because we are trying to make a good guess over here. We need to have a reasonable estimation of something, and it leads me to giving you a fair warning that both Black-Scholes and Kelly model are just models, and this is not predicting the future. This is about having a reasonable estimation. And now let's look at some graphs. We have specific dedicated interactive white paper to compare Black-Scholes versus Kelly. First of all, over here we are seeing a few returns distributions, as you've seen before. There is original one in blue, and there are two shifted ones. One of them is shifted to the right, which corresponds to the bullish market, and bearish one, which is shifted left. And also we have this dotted line, which is actually the distribution of returns, which corresponds to Black-Scholes model. Basically, Black-Scholes model implies that we have specifically this distribution, but important point over here is that all of those distributions are the same for the Black-Scholes model, because all of them have the same volatility. And with keeping that in mind, let's go and look at the backtest results of the Black-Scholes at each of those markets. First of all, let me explain that we are able to construct imaginary historical price paths via Monte Carlo technique. And therefore we are able to backtest Black-Scholes premiums at each of those returns distributions, which is shown over here. And of course, each color corresponds to the returns distribution of the same color. Over here we have CGR versus the drawdown, which is the usual risk-reward chart. And the important, I forgot to mention that each point over here corresponds to one Monte Carlo path, which was generated. And as you can see over here, blue ones are behaving well. We are having some reasonable drawdowns and CGRs. So basically, it shows that for this specific returns histogram, Black-Scholes are giving us really good estimations of premiums, which we should charge. But if we look at the green ones and red ones, we definitely understand that some scenarios could be or very fortunate or very unfortunate. Basically, you could lose nearly all of your money with the Black-Scholes just because Black-Scholes does not care much about the distribution itself. It cares only about the volatility. So there are risks. And to be honest, this returns distribution over here is not very realistic to happen in real world, because it's extremely negative. Like mean of this distribution is around minus 50%, which is huge number. But still, for illustrational purposes, it's legit. Now let's move on. Let's compare premiums of the Kelly versus Black-Scholes. So over here we see at y-axis we have premiums, and at x-axis we have strike. For the BSM we have just just one curve, and for Kelly it's actually a range, because Kelly premium depends on utilization, so therefore it's not just one line. And the point I wanted to make over here is that currently where we got these curves at full history of returns for the put option of Bitcoin. And currently Black-Scholes charges more, and it charges more at each strike value. But if we change mood from the full history to bearish market of the length 365 days, we are going to get very different picture. Currently, Kelly premiums are above pretty much everywhere, above the Black-Scholes. Once again, because Kelly is sensitive to what you are feeding into it. And for bear markets, of course, it's much more risky to sell put options, so we need to charge more, so premium is higher. And for BSM, premiums did not change that much because volatility could be the same. Although usually for bearish markets it's higher. Okay, that's all what I wanted to talk about over here. Let's move on. Sorry, scrolling is sometimes hard. This is the surveys of which compares premiums for Kelly and Black-Scholes. It's not much to talk here, frankly. I just wanted to show you that we're able to do the surface and compare not just in 1D but in 3D. Okay, and okay, yes. Yeah, I unfortunately tweaked one setting and now it's recalculating, but we're seeing the cached result over here. Yeah, sorry about the dim light, but you see the picture. At y-axis we have median CAGR, and at x-axis it's still the drawdown. And blue points over here are instruments which uses Kelly premium and which were backtested, and the same thing for the red ones, but those were using the premium from the Black-Scholes model. And over here it's easy to see that Black-Scholes could give us great results, and also it could lead us to ruin. But Kelly always produces what we call sustainable alpha, somewhat reasonable and not too big CAGR. So now let's sum it all up and switch back to the presentation. So just now I was talking about Black-Scholes versus Kelly comparison, and now we know that Black-Scholes model takes only one parameter which describes distribution, which is volatility, and Kelly takes all the distribution information into account. Black-Scholes model based on no arbitrage criteria, and Kelly is based on positive alpha, on creating positive alpha. And Black-Scholes models can potentially lead us to ruin if we are a bit unfortunate with the market we get. And Kelly delivers stable positive alpha if we know correct returns distribution in advance. So thanks a lot for listening. That would be all on my part. So let me head back to Alpha Block.
Thank you so much, Igor. Really interesting. Guys, so we're getting a little bit delayed relative to what we were expecting, but let's take a quick break right now to do something that I know that everyone likes very much, which is Whack Me time. Obviously, because we've done it before, we're a little bit worried that some people may just be trying to just come to the calls to get the NFTs. And the spirit, as you know, for us is to transition everything that we've built over to the community and make this a 100% community-centric project. And so what we're going to suggest is that you guys actually write here your Twitter handle. And the way that it's going to work this time around is you put here your Twitter handle, and then over the next 48 hours, we invite you guys to actually tweet something about Potion Analytics. Hey, Oleg, nice to see you, man. Good to see you here. Thank you so much. So if you can put here your Twitter handle, I repeat, put your Twitter handle, and then in the next 48 hours, tweet something about Potion Labs. If it's positive, obviously, we will appreciate it. But if it's negative, we will also try to learn from it. And then we will then tally up which Twitter handles did what. We will cross-reference it with your Discord user, and then we will be very happy to award you some NFTs. So thank you so much, guys, and seeing a lot of familiar names as always. Incredibly happy to have the community growing the way it is, and actually, let me take the chance to thank everybody in the Potion OG community. It really gives us a lot of energy to see you, even on the GM channel. You know, it's a really nice feeling, and I think you guys can have a massive impact on the future of the project. And with that, I'm gonna pass over to my other friend Mike, who is going to talk about the business of fat tails, why they matter, and how Potion Analytics deals with them. Over to you, Mike.
Hi, friends. Thank you, Alpha Block. I'm going to try to do this section of the presentation quick. So I know you guys have been sticking with us for a while, but you know, if we just start generally talking about what are fat tails in finance, right? So these are large moves in the price that come from events that aren't reflected in the price history. So that might be news or market crashes, or, you know, if like a company is a fraud, or if it's a crypto project, maybe it gets hacked, right? These are sudden things that you know, you weren't expecting, right? And so I have on the right just a picture of a high-profile one that happened recently. So this is the stock price of the company Wirecard. And, you know, they got added to the index, and then it turned out, you know, their accountants had been making up a whole bunch of the money, and they finally declared bankruptcy, and the stock went pretty much to zero. So, you know, these things are very common, and, you know, it might be something that you're not expecting. So the Kelly formula and the curves need to be adjusted for this type of thing, right? And so, oops, there we go. So if we remember from Nassim Taleb's Black Swan book, there's this thing introduced called the turkey problem, right? And so this comes from a US holiday called Thanksgiving, where it's traditional to eat a turkey, right? And the turkey gets fed happily and made fat for 1,000 days by the butcher But on day 1001, the turkey gets cooked and eaten, which comes as a huge surprise to the turkey. So this new information caused a huge change in its worldview, because the turkey previously knew the butcher as a friendly food giver, right? But it's not really a surprise to the butcher, just like it's not really a surprise to the accountants, right? And so, you know, in financial returns, right, it's like these fat-tailed events contain most of the information that matters, because, you know, the rare events here, like, you know, if the project was a fraud or it got hacked, right, it wouldn't really matter what's the day-to-day returns of the asset, just this one big event, right? And so what happens is that when you're calculating the statistical properties like the mean or something like that, they get dominated by these huge events, right? And just generally, like the probability distributions that you'd be using to look at the returns that Igor was talking about, they're called power law distributions, and they have infinite variance. And that might be like a scary sounding concept, but what it just means in reality is that the price could really jump to any other value, right? So it's a different approach here from just looking at the empirical samples, because when you're looking at the samples, you know, you're not making any assumptions about what the distribution might be. But in this case, we want to assume the worst case and assume that they have infinite variance, so that we're more conservative with our math and ready for these rare events, right? And so this, just if we think about comparing it to the Black-Scholes, right? This guy, he's a mathematician, Benoit Mandelbrot, and he's very famous for all the fractals and the pretty pictures that you might have seen. But in the 1960s, he showed that the returns of financial assets follow these distributions. And it's kind of interesting because the discovery was actually 10 years before the Black-Scholes formula was invented. And it's kind of well known in the math and physics community, but not so much the economics community. So the formula gained popularity, right? But, you know, if we just look at comparing the distributions from the formula to real life, right? This is a picture of Ethereum's returns that are the histogram here. And the orange is a normal distribution that would be used in Black-Scholes. And the red is a student T, which would be used in potion analytics. So you can see it fits it a lot better. And Mandelbrot actually showed that, you know, the normal isn't suitable at all for this type of stuff. And if we look, so the question is, like, when you're doing a parametric distribution like the student T, like, you got to fit it to the samples that are there. And this is a process called maximum likelihood estimation. Not going to go into the math in the PowerPoint, but just know that, you know, the tool's handling that for you. It fits the distribution to the samples that you observe. And so the parameters like mean and standard deviation and stuff like that, for any distribution, like those get found through optimization and not by just calculating it from the samples, right? And so it's really important, because if you think about what's happening out on the tail, right, it might take a super long time to collect enough rare events to populate the whole tail, right? And so if you think about, like, oh, a market crash, right, that might happen like every 10 years, let's say, right? It would take, you know, decades and decades to populate the tail. And, you know, you want to presumably start doing stuff a lot faster than that. So doing this method gets you accurate numbers with a lot fewer samples, right? And there's other advantages, like it always makes a smooth distribution, which is like consistent with your intuition, right? Because if you said, like, you know, a 10% move should be more common than a 20% move, that'll always be the case doing this method. And the big advantage of it, like I said, is the data savings, right? So this table is just a quick example to show you how much data gets saved. But even if the distribution that we're fitting has super fat tails, the parameters that we're finding through optimization are always normally distributed, and that's where we save a ton of data. So the measure of like how fat the tails are is this alpha parameter, and generally, like for financial stuff, it's between 1 and 2, and so 2 is something with thin tails like the normal distribution. So if we collected 30 samples in just 1 month of data, like how much would you have to collect if this parameter changed, right? And so, at 1/2, it might be years and years, and at 1.25, right, it's just an impossibly long amount of time. Like a human would die in that length of time. So it's good that we're doing it this way because we get to get better results with less data. And so just to compare the same bull, bear, and full markets that AlphaBlock was comparing, we can look at the curves for them. So the primary colors are just looking at the empirical samples. And so the bears are red, full is the blue, and the bull is the green. And then the secondary colors are if you use a student T instead. So the infinite variance of it makes the curves a lot more conservative, right? But otherwise, all the inputs to the Kelly formula stay the same. And so we have this dedicated repository for analyzing all the fat-tailed stuff, right? And so, there's tools within it for generating the curves and back testing them. You can do portfolios and back test the portfolios. And then there's a bunch of helper tools for downloading and organizing your training data. You can download and compare existing curves that other people might be using, some tools to manage the logs, and then we've made a video walkthrough series that guides you through using all these different tools. So it'll be super helpful if you want to learn how to use them. And so there's also, you can use it as a library within your own Python programs to generate curves, right? And so there's also, with these user guides, these step-by-step instructions for using the GUI and the walkthroughs, but also for the library, there's a bunch of usage examples if you want to use them in your own programs, right? And so they start with, simple hello world style examples and then progress to be more advanced. And these are all HTML and Markdown files, so you can open them up in a new tab and look at them as you're using the tools, right? And then there's also runnable versions of the usage examples in one of the modules. And then, of course, there's a bunch of referenced API documentation for using the libraries, and they go over every different function and parameter and stuff like that. But I think that's about it for the PowerPoint. I'll switch to a quick demo. So this is the curve generator, and I'm not going to go over all the different parameters because you can look at that in the walkthrough video. But it's going to output each of the different curves that you're interested in looking at. So for example, this is Ethereum, the full price history, and different strikes and expirations, right? And so we have two curves that are plotted here. And the blue curve is the minimum optimal curve that's output by the Kelly calculator. And then the red curve is the user's curve that's fit with the ABCD parameters that you would be, if you wanted to put into the web app and the smart contract, right? And so there's a bunch of helpful plots on the side. So if you wanted to look at the return distribution here versus the payout of the put option, you can see what the calculator sees when it's actually calculating this curve. And then you can look at also the training data that's selected. So this is the full price history versus in red what you pick as the training path. And then you can edit the different parameters here for the curve. So like say I wanted to, adjust this up. So it was, oops, I adjusted it down, but you might want to adjust it around so that it's in the profitable region, right? Because below the blue curve, like the user will be losing money on average, and above the blue curve, they'll be making money. So, you could adjust the curve upward into the region where you make money. And so, you might wonder, why not just adjust the curve like way, way up, right? And well, that's in the simulator, it might be okay to simulate that, and the simulator will run and do the math. But in real life, your curve would be less competitive versus other curves, right? And so that might lead to other users getting their orders filled when yours not. So closer to the blue curve is more competitive, but then you risk being close to the unprofitable region, right? And then the other tool I'm going to show off is the backtester. Like I said, I'm not going to go over all the different parameters, but when you specify all the different curves, it shows the outputs of the CAGR versus the drawdown, and it gets all plotted. And sure enough, because we're using the Kelly formula, it's consistent with our desire that our CAGR be profitable on average, right? And here's the outputs for each of the curves, right? So we have one that shows all the backtesting paths that were used in the simulation. So those are alternate scenarios for Ethereum. And then we can show the backtesting paths versus our PDF and the option payout, right? So sure enough, the backtesting was consistent with what the curve generator thought when it made the curve. And then down here, we have the performance results. So on the left-hand side, we have the ABCD curve that the user picked. And on the right-hand side is the blue curve that's the optimal, right? But yeah, you can see the different bankrolls and the CAGR. The black line is what's expected as the analytical output from the Kelly formula. And then, util is going to be constant for the simulation. And then these are the number of contracts that are actually traded, because, if you're keeping the util constant, as the price moves around, that'll change. So that's pretty much it. There's, like I said, check out the video walkthroughs. We'll be uploading those to the YouTube at some point. But for now, I'm going to pass it back to Alpha Block to wrap things up.
Thank you so much, Mike. I hope you guys can hear me now. Sorry, guys, for overrunning a little bit. This call was a little bit longer, but as you can see, we had a lot to go through. Let me just recap it real quick. We started with an introduction into Potion Analytics. This is kind of the laboratory, the kitchen. That's where you built the recipe. We spoke about how utilization is fundamental to returns. We saw how the Kelly Criterion leads you to this idea of sustainable alpha. And we ventured a little bit into the world of programmable alpha. Then we compared it to the Black-Scholes model, and we saw how it has a really constrained information model with a single parameter volatility versus the Kelly Criterion using the full range of information available in the distribution of returns. And we saw how, because of that superior information handling, the Kelly Criterion can stay above the profitability line, whereas Black-Scholes can still lead to ruin. And then finally, Mike told us about fat tails and the turkey problem, and how you really want to get a handle on those samples that are really far away from the mean, because they can really have a dramatic impact on your performance, and how we actually have an entirely dedicated branch to those types of assets. And so this was it today. Let's recap on where are we over the big timeline. A few weeks ago, we did the first announcement. 2 weeks ago, we went into the UX and the UI. Today, we went into Potion Analytics. And this is kind of the end of our kind of more educational side. And the next call is going to be all about the Unlock NFT, which I know people in the community are excited about. So are we. We really can't wait to play the game with you and everybody else, and to see the code being open sourced.